Joining us now, Jim Bianco of Bianco Research, RBC's Laurie Calvasina, and Colin Martin of Charles Schwab. Laurie, I want to begin with you. That concept, the end of easy money, does that resonate with you, Laurie?
It does, but I think, to be honest, John, we've been digesting this since March. If you look back in March, we saw value in small caps peak relative to the broad market, and that's something we would have expected to see once tapering began. So it does resonate with me. I think it's contributing to jitters, but I do think we've got a lot of the indigestion out of the way already, to be honest.
Jim Bianco, do you agree?
Sort of. I do think, the Fed wants to pull back and will try to pull back, but they learned the lesson from 2018 when they used the word automatic pilot and the market rejected it. They're very flexible. They'll make an announcement that they're going to taper, but then if there's an off ramp, they'll take it in the future.
Colin, we've had hikes from Norway. I need to talk to you about energy too. We've got crude back to 81 on WTI. We had a little look at 82 plus earlier. Brent crude at 83, just south of 84. Both of those, Brent and WTI, have been rallying really hard. Laurie, establish the relationship between what's happening right now with crude prices, the correlation between energy and the broader index too. What are you seeing that you think is worth paying a bit more attention to?
So, look, I think that as we've seen this market leadership shift from the big tech companies and the secular growers back to energy, back to financials, there's simply not enough weight in that energy and financial space to just sort of empower the S&P 500 to have this explosive move higher. It's been trudging along, perhaps better than I would have anticipated. But what we are starting to hear, John, as we're getting closer to reporting season, investors are starting to get a little bit uncomfortable with this energy price move. So we're starting to get questions on how is this going to impact margins for the broader market. We frankly think that it's kind of an earnings wash. It benefits the energy companies. It hurts other companies in other ways. Not hearing a lot of chatter about that yet, but I think that's something we have to watch for in this upcoming reporting season, the extent to which these higher energy prices are pinching corporate profitability in other sectors. Haven't heard a lot of it yet, but that's another risk we've got to look at.
Hey, Colin, I imagine we're going to hear more about it. And my apologies for cutting you off earlier. A bit of a problem on my end hearing you. Colin, just weigh in on that if you can. The correlation between risk assets and what's happening with energy prices at the moment.
Well, one benefit of the high energy prices and still rising is that energy junk bonds have done really, really well this year. They've been the strongest performer in the whole high yield market and have helped drive total returns higher. But now when you look at the market as a whole, spreads are still low. There's very little juice left to squeeze. And while those benefits are flowing into energy companies, it's a risk for everyone else in terms of higher prices, higher supply prices, all those things we're hearing about in terms of shrinking margins. So it's getting us a little bit more cautious on the riskier parts of the market, especially triple C's and junk, where there's just very little room to move higher. And if we see these supply chain issues continue longer than expected, that's going to be a challenge there, and we can see prices fall.
Jim Bianco, can you add to that, if you can, please?
Yeah, I think the supply chain issues are going to be the most important thing to look at going forward from here. Look, they're already lasting longer than most of us ever thought. They're probably at their worst point right now, and we're not looking at any sign of them turning around soon. I think it's a function of too much demand, overstimulation by governments and central banks, and they seem committed to continue to do it. I know we've talked that around the edges they might be starting to pull back. And my fear is that that's going to lead to the old adage that the cure for higher prices is higher prices. And wait till you see how high these prices have to go, especially energy, to cool off demand.
Higher prices weighing on demand. Let's have a look at a Goldman call this morning and work through it together as well if we can, Jim. This came from Jan Hatzius. I caught up with him a little bit earlier this morning. After updating our estimates of the key growth impulses that drive our consumption forecast and incorporating a longer-lasting virus drag on virus-sensitive consumer services spending, we now expect a more delayed recovery in consumer spending. They're now looking for something closer to 4%, the line in the sand for them next year, down from 4.4. It's a small revision this year to 5.6 from 5.7. But Jim, one thing that stood out for me is that they think we get back towards trend 1.5 to 2% by year end next year, back half of next year. When you talk to clients at the moment, Jim, are they discussing that sharp deceleration back to 1.5 to 2% next year?
Well, they are discussing this deceleration in the economy. I don't know if they're all at the same level that they're thinking about trend growth, but there's definitely been a disappointment, especially in the third quarter when you look at most of the numbers. The Atlanta Fed has got, GDP down around 2% or so, and we expect that to pick up in the fourth quarter and the early part of next year. but there is a slowing of the economy, and it isn't moving along at the level that we were thinking even 3 or 4 months ago.
Reason I bring that up, Jim, is because, Laurie, you're really constructive next year. You're looking for this choppy story through year-end and constructive. Let's talk about taxes with Jim Bianco, Laurie Calvasina and Colin Martin. Jim Bianco, for much of this year, through the first quarter, DC was a tailwind. Keep going back to this question. Just quite simply, from your standpoint, your perspective, is it now a headwind?
Yeah, I definitely think it is a headwind. There's no real agreement in D.C. about what to do. As you mentioned, the biggest argument right now is it's Democrats among Democrats because the Republicans have been left out because they're the minority of both chambers of Congress right now. So as we move forward, we have to ask whether or not the reconciliation package will look anything like we think it does today. We couldn't get it passed, and that's why we had a debt ceiling push until early October. As far as the international tax agreement goes with the treaty, the estimates that I've seen is that it's maybe 10 years away from happening. It's not going to happen right away. 136 countries have to ratify it. That's not happening overnight. So this is going to be a very long slog. And in the middle, we're going to have a lot of uncertainty and we're going to have a lot of confusion moving forward.
And Colin Martin, your thoughts on this? Let's talk about it, Jim. Are rates going up for the right reasons?
That's to be determined, I think. You're right, though, that rates go up for one of two reasons. Everybody likes to think it's because of growth, but if it is because of inflation, it might not be the right reason for it to go up, and the banks might have some trouble. And John, let's be honest here about the banks. They have been the worst. The financial sector has been the worst performer of all the 11 S&P 500 sectors for the last 23 years, for the last 10 years, and for the last 5 years. A lot of careers on Wall Street have ended because people have fallen in love with banks. I agree with Laurie. They're good for a rental right now that they're probably going to go higher. But the long-term prospects of the banking system has been very terrible. And that's why you've seen such horrible underperformance by them for decades and why they've got such good valuations, because they can never really deliver on the hope. And now we've got disruption coming for the banking system, whether it's in the form of fintech or cryptocurrencies. And I think investors have been wary of this sector for decades, and they've been right to. And I think after this rental that banks go higher and financials do well, I think those worries will return.
If I was to walk away, really good point. Jim Bianco, can I get a final word from you on that, sir, just on that topic of reflation?
Yeah, I think it's important to separate the two issues there, is whether or not it's being driven by growth or it's being driven by higher prices. And coming out of the August low, I do fear that the market is more worried about higher prices, and that is just a reduction of purchasing power. That is a reduction of demand, of growth, because we're just going to have to just pay more for the same thing that we used to get just a few months ago.
Jim Bianco, Laurie Calvasina, Colin Martin. Guys, been great to work through this market with you. Around about 12